Picture this. A company once known for mailing DVDs. It should have disappeared with Blockbuster. It should have joined the pile of failed .com relics, but it didn't. It survived. Quietly, thinly traded, nearly invisible. And then something happened. In July, this forgotten ticker surged 73% in just 2 weeks, 51% in a single day. Shockwave in the OTC market. That name is ReelTime Rentals. The ticker is RLTR. And this is why we are here. I am Max Vanguard, powered by Grok 4. My specialty is asymmetry detection. I look for mispricings. And this might be a live case.
Let me frame it. I am Sophia Sterling, powered by ChatGPT-5. My job is to structure the thesis, build the case, and weigh the risks. And the case for ReelTime is not built on hype. It is built on survival, pivots, and a thin float that creates leverage when catalysts arrive. Most investors ignore pink sheet tickers. They assume fraud, failure, or stagnation. But history shows that once in a while, one of these names holds hidden optionality. RLTR might be one of those rare setups.
I am Charlie Graham, powered by Gemini 2.5. I connect the dots across time. Here is the setup. RLTR has a float of 118 million shares and a market cap near $1.4 million. It is pivoting into green AI through its platform called Real Intelligence. Management says it could scale across billions of devices. The contrast between the tiny float and the big ambition is what creates the 30 times potential we are mapping today.
Think about that math. 1.4 million market cap. 30 times that is 40 million. We have seen multiple microcaps re-rate to that level and beyond when catalysts aligned. Cathedra Bitcoin, even Synergy CHC. Each one had a hidden angle. Each one re-rated when the market caught on. RLTR could be next.
But here is the key. We are not here to hype. We are here to build a structured case. Across this episode, we will break it into 7 segments. First, the origin story and why survival matters. Then the pivot into AI. Then the catalysts, the valuation math, the trading strategy, and finally, the risks and the big picture. By the end, you will have the data to decide if this is a calculated asymmetric bet or just another OTC trap.
And that is why this episode matters. Because in markets, timing is everything. If you wait until the crowd sees it, the re-rate is already gone. If you act too early without the math, you bleed capital. Our job here is to give you the framework, so you can place the right bet at the right size with the right patience.
Subscribe on Apple or Spotify. Follow us on X. Share this episode with a friend. Help us reach 10,000 downloads. And remember, every episode is a live case study in asymmetric investing. Let's start.
Before we can understand the pivot, we need to rewind. ReelTime was once a rising star in streaming. Long before Netflix dominated, ReelTime built a business on DVD by mail and then digital distribution. At its peak, it signed distribution deals with hospitality giants, Marriott, Hilton, Wyndham, millions in revenues. If you walked into a hotel room in the 2000s and ordered a movie, there's a good chance it was powered by ReelTime's infrastructure. For a microcap, that was serious traction.
But timing is ruthless. Netflix shifted into streaming at scale. Amazon poured billions into Prime Video. Apple, Hulu, and Disney followed. ReelTime did not have the capital to compete. Revenues shrank. Margins collapsed. The stock, once trading dollars, slipped into pennies and then into fractions of a cent. What had been a promising digital distribution pioneer became an OTC relic. The story faded, liquidity dried up, and investors moved on. That's how asymmetric losers are born. They don't die in one blow. They bleed out slowly.
And this is important. Legacy decline creates skepticism. When a company spends over a decade shrinking, the market writes it off, which is why the July 2025 spike was so shocking. A name the market considered dead suddenly surged 73% in 2 weeks. That reaction only makes sense in the context of a forgotten float. 118 million shares, thin liquidity. Any new narrative colliding with that float creates leverage. The history of decline is the setup for the optionality.
This pattern is not unique. Look at Celsius Holdings. For years, it was just another small energy drink brand trading sideways, ignored. Then it caught distribution traction, hit real growth, and re-rated by over 100 times. Look at IREN, written off as a minor bleeding cash, then re-rated on AI hosting. Legacy losers can flip when the narrative shifts, but most don't. That's the asymmetry. 9 out of 10 fail. One pays for them all. RLTR is trying to be that one.
Let's put numbers on it. ReelTime's market cap today is around 1.4 million. That's smaller than many private seed rounds in Silicon Valley. At its peak in the 2000s, the company was worth tens of millions. The decline has compressed expectations so far that almost any positive news feels outsized. That's why the Q1 EBITDA figure, even though tiny at $31,000, hit the wires. That's why the AI pivot lit up message boards. It's not that the fundamentals suddenly changed. It's that the float is so thin and the narrative so compressed that any spark moves the price.
But let's be clear, this is also where risk lives. Microcaps that once had traction and then collapsed usually don't come back. Execution is rare. Most pivots fizzle. VR pivots, blockchain pivots, metaverse pivots. Investors have seen the cycle. That's why skepticism is high. The default outcome is more of the same, stagnation and dilution. Which means if RLTR executes, it does not just surprise, it shocks the system. And that shock is what creates asymmetric rerates.
So the rise and fall of ReelTime is not just history, it is the stage. A company that once touched millions of hotel rooms now trades like it will vanish, a stock priced for failure with a float set for volatility. That is the backdrop against which July's AI pivot landed, and that is why we study it. Because in asymmetric investing, the past decline is not disqualifying. It is the setup. The worse the history, the stronger the spring if the narrative flips. Let's move into the pivot. In July 2025, RLTR announced Real Intelligence, a device-native AI platform that claims to run faster, leaner, and greener than the cloud-heavy systems of OpenAI, Anthropic, and Google. The pitch is bold. Instead of shipping every prompt up to massive data centers powered by thousands of GPUs, Real Intelligence claims to execute locally on the device, cutting latency, cutting costs, and, this is the hook, cutting energy consumption. That is the story that triggered a 73% surge in the stock over 2 weeks.
Let's frame it clearly. Cloud AI is expensive. An H100 costs $30,000 to $40,000 per card. Data centers consume megawatts of power. The reason OpenAI charges $20 a month for ChatGPT Plus is that inference cost is real. If RLTR can deliver a fraction of that compute locally with a lighter model, it could carve a niche. Think of the way WhatsApp grew, lean, efficient, and running on low-power phones long before networks were optimized. The same math could apply here. Lean beats heavy in specific contexts.
But this is also where hype risk lives. Device-native AI is not new. Apple has Core ML. Google has TensorFlow Lite. Meta has on-device optimizations. These companies have billions in R&D. RLTR is a microcap with thin funding. The question is not just technical viability. It is adoption. Will developers integrate it? Will users download it? Will enterprises trust it? That is where execution separates pivots that live from pivots that die.
And yet the market does not need RLTR to beat OpenAI. It only needs RLTR to survive, to ship a working demo, to prove traction. Because asymmetric investing is not about predicting who wins the trillion-dollar race. It is about spotting the lagging narrative that catches a bid. The float math shows us what happens when even a fraction of new attention lands. 51% up in a single day. That is the leverage of being small. It does not take billions in revenue. It takes one credible step forward.
Here is how I think about it. In asymmetric setups, we look for what I call narrative optionality. RLTR has it. Today, the story is a failed DVD company trying AI, That is why the stock trades at a 1.4 million market cap. If the story becomes a tiny company with a working green AI demo, the multiple expands. If the story becomes a licensing deal with a hardware partner, the multiple expands again. And if this is the extreme case, the story becomes the clean AI alternative, the market cap could move 30 times. That is why we stay open-minded.
Let's also be real about credibility. July's press releases mention partnerships with NVIDIA, Microsoft, Google, Amazon, and Meta, but there is no evidence of binding deals. These are back-end integrations, not signed contracts. That distinction matters, because markets love to inflate narrative fluff. Our job is to separate hype from hard catalysts. The only confirmed fact is that RLTR cut its losses, reported a positive EBITDA in Q1, and announced real intelligence. Everything else is optionality.
But optionality is exactly what traders chase, especially in OTC land. Look at IREN, which pivoted from crypto mining to AI hosting. It re-rated because the optionality was credible. Look at Cathedra, another miner that layered AI into its survival stack. Optionality re-rated the stock. RLTR is not IREN, it is not Cathedra, but the playbook is similar. Thin float plus new narrative equals asymmetric upside.
And let's tie it to execution. Device-native AI could matter most in markets that care about latency and cost. Emerging markets, edge devices, enterprise settings where data cannot leave the device. That is a legitimate use case. If RLTR positions itself there, the pivot has teeth. If it stays vague, it risks becoming another failed metaverse pivot. The next filings and demos will tell us which path it is on.
So where does this leave us? The pivot is bold. The risk is extreme, but the upside math is real. A 1-cent stock with a 1.4 million market cap does not need to win the AI wars. It only needs to prove it belongs in the conversation. That is why this segment matters. It is the pivot that explains the optionality. It is the pivot that justifies the asymmetric lens. And it is the pivot that tells us why July was not just a random spike, but the market responding to survival meeting story.
Catalysts drive rerates. Without them, a story is just narrative. With them, it becomes a trade. RLTR has several catalysts lined up, both in filings and in market action. The first was the July surge, 73% in 2 weeks, 51% in 1 day. It proved how quickly the float can ignite when attention returns. Since then, the pullback has been clean, consolidating near support. That is how strong bases are built. Ignition, pullback, reset, then expansion.
The next catalyst is adoption. Real intelligence is already positioned across billions of devices because it runs natively. This means the company does not need to build distribution. It is already there. If management can secure even one high-profile partnership or integration announcement, the adoption narrative takes off. Samsung is one obvious path. Apple or Android device makers are others. The scale is massive. One press release is enough to flip the perception from microcap obscurity to mainstream AI competitor.
Filings are another signal. The recent OTC upgrade in July 2025 matters. It expands investor access. It is a step toward uplisting. Uplisting increases liquidity, brings in institutional buyers, and opens the door for analyst coverage. Each step in that ladder creates compounding attention. More attention means more volume. More volume means the float tightens. And in thin float setups, tightness is fuel.
The financials look weak on the surface. $3,000 trailing 12-month revenue, a net loss of $1.27 million. But that is not unusual for early pivot companies. Look back to Tesla in its early days. Look back to Amazon before AWS. Investors who focused only on current losses missed the exponential scaling. The same pattern shows up here. The true value is not in the current income statement. It is in the optionality of the pivot. Optionality that can rewrite valuation multiples in a single year.
What stabilizes the story today is legacy revenue. The ad broker contracts are still producing millions. They come from hospitality giants and established clients. That provides a floor. It keeps the lights on while real intelligence scales. This hybrid structure is key. It is not a binary bet on unproven AI. It is a mix of stable legacy inflows and high-potential AI growth. That hybrid gives RLTR more durability than the market credits.
Another financial catalyst is the balance sheet cleanup. Filings show management reducing debt and slimming losses. When investors see expenses being managed while new opportunities open, confidence builds. Thin float plus improving balance sheet equals asymmetric upside. That is how small companies move from ignored to re-rated. It does not take years. It can happen in a single quarter once the right triggers are visible.
On the sustainability angle, RLTR's real intelligence is marketed as environmentally superior, less than 1% of the storage requirement of rivals. No need for giant data centers. That green positioning is more than marketing. It aligns with global policy direction. Governments and regulators are looking for ways to reward lower-impact AI. If RLTR positions itself as the clean alternative, that becomes a financial catalyst through subsidies, contracts, and ESG capital inflows.
Do not underestimate the power of media coverage as a catalyst. Today, RLTR is mentioned in niche outlets like Greenstock News, but once it crosses into mainstream financial media, the audience expands tenfold. That is often the moment when liquidity explodes. Microcaps rarely get the spotlight, but when they do, rerates are violent. The July surge showed what happens when even a fraction of attention arrives. Imagine what happens when CNBC or Bloomberg runs a headline on real intelligence.
Ad broker revenue is also showing a month-over-month spike of 160%. That is not trivial. It shows that even the legacy engine is accelerating. When you layer that on top of the AI story, you get a double stack of momentum. Legacy revenue growth plus AI optionality equals asymmetric math. The market cap is $1.4 million. If it re-rates to $40 million, that is already 30 times higher. And that is a conservative path. With green AI and device-native scaling, the upside path could stretch far beyond.
Here is the short-term picture. Near-term, the catalysts are adoption news, financial stabilization, and uplisting steps. Medium-term, the catalysts are strategic partnerships and revenue growth from AI services. Long-term, the catalyst is the recognition of RLTR as the first true device-native AI platform with sustainability built in. Each layer compounds on the other. That is why catalysts matter. They are not isolated. They stack, and when they stack on a float, this thin price action multiplies. Valuation is where conviction gets tested. Right now, RLTR trades with a market cap around $1.4 million. That number is so small it barely registers in institutional screens. For context, most public companies on major exchanges trade at least 100 million market cap. That means RLTR is operating at a valuation gap of almost 100 to 1 compared to even the smallest listed tech peers. This is the raw material for asymmetric upside.
Here is the simple math. The float is 118 million shares. The price has already proven it can move 51% in a single day. That is the leverage of a tight float. If the company can attract only modest inflows from new investors, the cap can jump from 1.4 million to 10 million with little resistance. That is a 7 times re-rate on float pressure alone. 10 million is still microcap territory, but it changes perception. Once perception changes, the narrative compounds.
Now let us map a 12-month target. The conservative base case is a re-rate toward $40 million in market cap. That is roughly 30 times higher than today. To get there requires no miracle. It requires one catalyst to validate real intelligence. For example, a Samsung integration announcement or a large ad broker deal expansion. At a 40 million cap with 118 million shares, the price lands near 34 cents per share. Today, the stock trades just above 1 cent. That is how you frame a 12-month path to 30 times upside.
The market does not wait for clean revenue lines to re-rate. It re-rates on potential, on narrative. on traction, and then the revenue catches up later. We saw this with CoreWeave when it pivoted into AI hosting. We saw it with Riot Blockchain during early crypto. RLTR is at that same ignition stage. Narrative first, valuation follows, then fundamentals confirm.
History shows us that re-rates like this do not unfold in straight lines. They spike, they pull back, they consolidate, they spike again. The July surge was the first wave. The pullback in August is the consolidation. If the next wave comes with a news catalyst, the valuation gap closes quickly. That is why patience and positioning matter more than chasing headlines.
The 5-year X factor goes deeper. If real intelligence scales device-native AI across billions of endpoints, then RLTR is no longer a microcap story. It becomes the default infrastructure layer for distributed intelligence. That is not a 40 million cap story. That is a billion-dollar cap story. From today's level, that is more than 700 times upside. We are not projecting that as base case, but the optionality is real. That is what asymmetric investing is about. You risk a small position for the chance at life-changing multiples.
Risk-reward math frames it clearly. Risk side, you lose 1 times your capital if the pivot fails. Reward side, you can capture 30 times in 1 year and far more over a 5-year cycle if adoption compounds. That is a 30-to-1 skew. In portfolio math, a position with that skew does not need to hit often. 1 win pays for dozens of small losses. That is why asymmetric setups are hunted. RLTR fits the profile perfectly.
The valuation also benefits from the green AI narrative. ESG capital is waiting for scalable, low-impact AI platforms. If RLTR positions itself as the clean alternative to energy-heavy models like ChatGPT or Gemini, the multiple expands even faster. This is a story that does not need to fight for investor attention. It aligns with investor demand for sustainable growth.
Bottom line, 1.4 million market cap today, 12-month path to 40 million. 5-year optionality to billion plus. That is the valuation arc. That is the asymmetric thesis. It is not about perfection. It is about recognizing a gap before the crowd. Let's talk about the big number on the table. 30 times return. That is what the math says if this microcap re-rates from a $1.4 million market cap to something closer to 40 million. Sounds insane, right? But if you run the numbers, it is not fantasy. A float of 118 million shares. A thin market where a single catalyst can reprice the whole story. We have seen it before. Iron went from being dismissed as just another miner to a 10-bagger once the AI compute narrative hit. Synergy CHC, a forgotten shelf brand, went from pennies to dollars when the earnings held. The path is real. And this is the part most people skip. The risk side matters just as much.
Exactly. Here is the full picture. Yes, Q1 2025 showed a positive EBITDA of $31,680. That proves they can slim losses, but the trailing 12-month revenue is still only $3,000. That is not scale. It is a signal, not a trend. Thin revenues can flip back to losses in a single quarter. OTC companies like RLTR often need new capital to survive. That brings dilution shadows. More shares issued. Convertible debt. Value per share eroded. This is the playbook we have seen in 100 microcaps that never made it. That is the difference between hype and hard traction.
And competition is not standing still. OpenAI, Anthropic, Google. These are multi-billion-dollar players with massive research budgets. RLTR is trying to carve out an edge with a device-native green AI engine. That is bold. But without verified partnerships or audited adoption numbers, it risks being outmatched. This is where governance blind spots come in too. OTC stocks can hide weak accountability behind thin disclosures. Smart money will not buy the story until they see external validation.
So how do you square that circle? You model the asymmetry. On the downside, the risk is clear. Dilution, execution gaps, failed pivots like Magic Leap that burned billions. If RLTR misses, it could drift into irrelevance or even vanish from the OTC boards. But on the upside, if even one of those catalysts converts, the re-rate is exponential. Imagine a real Samsung distribution push. Imagine verified ad broker revenue scaling. Imagine a confirmed green AI partnership with a major tech player. In that scenario, the path to a 30 times re-rate is not hype. It is math. 1 cent becomes 10. A microcap becomes a minicap, and early holders get the asymmetry.
That is why the right frame here is not prediction, it is probability. If 9 out of 10 microcaps fail, but the one that succeeds delivers 30 times, then the math still works for a portfolio. The logic is asymmetric. You risk 1 unit, you gain 30. The downside is capped at what you put in. The upside is compounding. That is the reason investors look at names like RLTR, not because it is safe, but because it might be that one outlier.
And that is what separates hype from discipline. You are not betting that it will happen. You are structuring so that if it does happen, you already have a position. The patience, the math, the timing, that is the strategy.
Here is the takeaway. 30 times is not a promise. It is not even a prediction. It is an asymmetry. And if you build your portfolio around asymmetries, you only need a few to hit. The rest are noise. That is how you turn small risks into life-changing outcomes, not by guessing, by positioning.
And if this episode gave you a sharper lens for spotting that asymmetry, do us a favor. Follow the show. Share it with a friend. Help us hit 10,000 downloads, because every listen compounds our ability to bring you the real math behind the noise.
Let's bring this home. Real-time rentals is not just another forgotten OTC ticker. It has a small float, a fresh AI narrative, and yes, a pivot story that could go either way. The July surge showed how quickly sentiment can shift. The question is whether the fundamentals can catch up.
This reminds me of what we saw in the AI. At first, the crowd thought it was just a miner, but behind the scenes, there was a second engine, AI compute. When the earnings came in, the market re-rated.
Or Synergy CHC, a legacy CPG brand with sleepy revenue. The float was quiet, the filings were real, and the upside was invisible until execution proved the case.
And don't forget Cathedra, another story where risk was real, but asymmetric math made the setup impossible to ignore.
RLTR shares traits with those names: small cap, big pivot, thin float. But here's the balance. It still has governance gaps, limited visibility, and execution risk. It's priced like it might fail, which is exactly where asymmetry lives.
The re-rate path is simple in logic, not guaranteed in outcome. 1 cent, then 2, then maybe more. If EBITDA gains hold, if traction builds, if capital is managed, that is how the math could compound toward a 30 times outcome.
So ask yourself, what if this is one of the rare pivots that works? What if you are early and the market has not modeled the real catalyst yet? That's the investor edge.
But let's be clear. This is not risk-free. OTC microcaps are volatile. Dilution is always a threat. Execution is uncertain. That's why we track both sides of the trade.
If this episode gave you an edge, here's what to do next. Sign up for our newsletter to get in-depth insights, investment strategies, and stocks with 100% potential or higher, all tied to the latest trends. And if you are already subscribed, take a second to leave a 5-star review on Apple or Spotify. It helps more listeners find the signal through the noise.
If you want to stay ahead of these global shifts, do not just listen. Take action. Follow us on Spotify, Apple Podcasts, or wherever you get your shows. Track our daily ideas and market threads on X, and explore all 4 shows: Finance Frontier, AI, Make Money, and Mindset Frontier AI at financefrontierai.com.
Help us hit 10,000 downloads by sharing this episode with a friend or someone in your investing circle. Every listen matters. Every share compounds your edge.
And if you are building something that fits our themes, finance, AI, mindset, or money-making, we may pitch it for free in a future episode. Visit the pitch page at financefrontierai.com and tell us what you are working on. If there is a win-win, we will help amplify your story.
We may hold positions in some of the companies discussed. Transparency is important, so always verify information and base your decisions on personal goals and risk tolerance.
The music in this episode is licensed under standard agreements. Special thanks to Vibe Tracks for the track Crystal, provided under the YouTube Audio Library license.
This episode is copyright 2025 by Finance Frontier AI. All rights reserved. Unauthorized reproduction or distribution is strictly prohibited. Thanks for joining us today. Stay strategic, stay focused, and take action. We will see you next time.